the last two rounds, we probably allowed our employees to cash out around 30 million. 60-70% of our deal was on the earnout. We took 10 million each. They bought it for, I think, 500 million. And today, I think Booking.com is worth like 150 billion.
Yeah, that's huge. Today on Billions, I'm sitting down with Arthur Waller, one of the sharpest French founders of his generation. He sold his first company to Booking.com in his 20s, and instead of retiring, he came back to build Pennylane, a fintech that turned accountants from enemies into growth partners and became one of Europe's fastest growing unicorns. In this episode, we will discuss how 6 co-founders actually share power, what founder gets wrong about fundraising terms and dilution, and what Arthur thinks about secondaries, freedom, and building a company that lasts 20 plus years. If you want to understand what it really takes to scale, cash out without selling out, and keep your ambition alive after success, then this episode is for you. Arthur, thanks a lot for being here.
Thanks for having me, Guillaume.
I'm super excited to have you on because I think your story is pretty amazing. The first thing I want to talk about, because I know we have a bit less than an hour, is the story of how you essentially sold to Booking.com. You were 6 co-founder, I think, at the time. Can you kind of share the process of how you came up with the idea up to the moment you decided to sell?
So the idea of Price Match, the first company, which was a revenue management software for hotels, I would say we basically were in college and we wanted to launch a company. We thought we had nothing to lose launching something at that age. And what I always say is I think we were not really right on the ideation process. We were more thinking about what we had learned at school, and we felt like this was our edge.
Okay.
And so we tried to think of a space or an idea where we would apply what we had learned. And so I studied econometrics, which is kind of, maybe like machine learning before machine learning. And so we came up with that idea trying to forecast demand for hotels and recommend prices, but a bit randomly, having talked to one hotel inspired by a company in the US that used to do this for pricing for baseball tickets. But I would say we really first started with us, and then we kind of went still to customers to confirm that our idea was good, but we didn't start with the customer's pain point. And so we launched that company, we built a product, we thought it would sell alone, and it doesn't. And so, then we had to scale our go-to-market. Was a very, not easy go-to-market where we had to cold call, sell a free trial, convert a free trial, etc. We also realized pretty quickly our market ICP was big cities because there's more variance in demand in big cities. So it was easier for us to sign our next customer in New York or Berlin than to sign it up in Dijon.
Okay.
Even if the product was built for France. So we very quickly went abroad. And so for that company, we didn't know anything about fundraising, but a bit randomly, after a year and a half or so of having bootstrapped the company, we raised the seed round. Half of it with a customer, a guy owning hotels.
Nice.
And the other half with a French VC called Partech. And then, company started getting traction. And the moment we were about to raise our Series A, we actually got an acquisition offer from Booking.com, which we ended up accepting. So
yeah, that's really awesome. And I think the total amount from basically the deal itself and the earnout was around 80 million. Is it correct? Or
yeah, that's okay. Correct. Yeah.
Can you share kind of the split between the cash upfront and the earnout that you had?
Yes. And the structure of the deal was a bit special. So basically how it worked is that Booking agreed to buy the company at the same valuation we were about to raise funds for our Series A, which was around 20 or 25 million. And then they gave us, the founders, stock options, which was basically employee, ESOP from Booking.com, regular ESOP that they give to the management of the company. And we were lucky enough because the price of the share of Booking doubled during our 3 years there. And so we ended up getting a lot of our, probably 60-70% of our deal was on the earnout. What was also a bit special is we didn't have any, so it was pure ESOP, right? We didn't have any
no
targets.
Milestone to reach or, okay. And essentially because I think Booking.com got acquired eventually down the line, or they are part of an American company.
Yeah, so Booking.com got acquired in 2005.
Okay, so way before. Yeah. Okay, and you were working with the founder, right? At the founder of Booking.com was an employee when you were there, or did
He's
he?
an employee,
Yeah.
like a random developer, software developer.
And was he still there
So
when
he,
you sold your
yeah, yeah,
company?
yeah.
Yeah. Okay.
But he sold this company, actually. He sold Booking.com to some other Dutch entrepreneurs.
Okay.
Those other Dutch entrepreneurs kind of grew the business. They then sold it to this American company called Priceline, who made Booking like their European toy, if you want. But they were smart enough to keep it very independent. And Booking.com outperformed by far the American company Priceline. And so now it's a group that until recently was called Priceline Group. And now they've renamed it to Booking.com Holdings.
Okay.
Because Booking is probably like 90 or 95% of the value of the group.
Okay.
And the
insane.
group has Booking, Kayak, Agoda, OpenTable, rental cars, but Booking is worth 95% of all of this. So it's probably, I mean, people say it's one of the most successful M&A transaction because they bought it for, I think, 500 million in 2005. And today, I think Booking.com is worth like 150, something like this, billion.
Yeah, that's huge.
And Booking is worth like 95% of it. So I hope that the recent M&A you've done will be as successful.
I hope so too. I hope so too. And usually, you know, when a company gets acquired, the earnout phase is always like a bit tough for founders because they have to stay, you know, like in another company. And you basically spent 3.5 years like being, you know, the captain of your ship. And eventually you had to stay at Booking. I saw that you stayed there for about like 3.5 years. Did you enjoy like staying there for that long, or did you feel it was like, you know, like shorter? What was your take on this?
So we loved our time there. The thing is, Booking was not very experienced in M&A, surprisingly for a company that size. So Priceline, which is the holding company, they had bought like, I don't know, maybe 6-7 businesses that they had kept very independent each. But Booking itself, we were, I think, the third company they were acquiring. And the two first companies were very tiny, small software companies. One building a property management software for hotels, and the other one building a website builder for hotels, like a Wix.com for hotels. One out of Barcelona, the other one out of Seattle. And those M&A transactions had happened couple of months or years before us. And I would say they had not been super successful. And so Booking had some very clear things they didn't want to happen again when buying us. So one of them was like, you don't let the company, you know, keep going too much standalone. You want to integrate them as quickly as possible. And so that's why, like, we signed the acquisition, and I think like 15 days later, the founders, we had to move to Amsterdam, be there in Amsterdam, work. Our employees, they had to move to the Booking.com office very quickly in Paris. So I think this we've done really well. I think what we haven't done well, and I put myself in, right, because I was part of the team, is we haven't taken the time to do proper strategic planning. So their main concern was like, we want you to keep running. We don't want to lose the
momentum.
The momentum you have, but we didn't take the proper time to think strategically, you know, what does this change? Also, what does Booking want to get out of this acquisition? And then also the other bad thing that happened to us is I think the one driving the acquisition was the CEO of the group, and he left the company like 6 months later. And so then after he left, I think nobody really knew what was expected, not only from us, but so they had created. So the thing is, like, Booking is great at bringing reservations, bringing business to hotels in a very efficient way. Hotels complain, right, because they say it costs too much. But they also don't want to invest on their own IT. So, but still, Booking always said, you know, if someone comes and brings reservation at a lower cost as efficiently, hotels would not be super loyal, right? And so the former CEO, he said, like, I want to give more than just reservations. And so he started building a B2B SaaS department with those companies I just mentioned. But nobody really knew what was expected from this B2B SaaS department. Was it extra revenue? Was it more stickiness? Was it more like share of wallet from those hotels that would buy our product? And I think this is what's super important to define. and it's probably tough, right?
Yeah.
You need to make choices. So I think that's what is the toughest, and that we didn't do super well. Right?
Yeah, makes sense. And I feel like whenever there's an acquisition and the person in charge of the acquisition just go away, it's never easy. I've been talking with another person was like leading M&A at I can't really mention the company, but basically like management changed a few times, and for him it was like a nightmare because when management change, like strategy must change, and it becomes quite a mess. At that time, essentially, like after getting acquired at Booking and doing the earnout, you're basically like still super young, multi-millionaire, but still you decide that you want to continue and also continue with the same co-founders. So I have several questions because the first question I want to ask is, once you have like a successful company and a successful exit like this one, how exactly, like what's your thought process for the next company? And also, why do you decide to raise when you actually have potentially enough money to get started and keep more ownership?
So maybe the first question is like, why did we go back at it? So we actually invested a lot of the money we made with Price Match. We invested it back in startups.
Okay.
And we loved getting the adrenaline out of it. So we loved our time at Booking, but you still feel a bit like a water drop in the ocean. And so we loved the energy. We felt also the French tech ecosystem was thriving and growing. And so we never regretted having sold too early, and we loved having Booking as a partner, and they've done everything they had promised. So I would recommend them to every company that would get an offer from them. But we wanted to go back to building and having more, like feeling more the impact maybe first, and also just having more adrenaline of like the early days and stuff like this. And so we were way more kind of rigorous and scientific about the ideation phase. And one of the criteria was we want a huge market.
Okay.
We were a bit frustrated in the first company. And when I see now my competitors from that time, I feel they are still all doing, between 20 and 60 million AR. And even the best ones, like the market is not that huge, right? So that was the first thing. And we said, okay, we want to do a second business. We probably won't do a third. It's like the last one, but this one we want to keep going for as long as we can. And as long as we are still excited, not bored, and find it interesting. The second criteria was, software. That's what we know how to build. And I would say Booking was like an MBA in managing large tech product design data teams. And the third criteria, which was maybe a bit more unusual, was we wanted a market where we come and replace something. And so that goes back to my point that the first company, we were rather trying to think about what our edge is. This time we were looking for a market where there's a real pain point. And so I would say when people already have or paying for software and they are not happy, there is a budget. And if they are not happy, there is a pain. And so we felt it's in some way it's tougher because, people don't like changing, right? So there's this problem, but I still feel you own your destiny more if you don't have to replace Excel.
Yeah.
Replacing Excel is super risky, uncertain. And so we were really looking for a market where we would come and replace something. We were also very inspired by a wave of French company that had kind of popped up at that point, going after super large legacy markets. So, Payfit for payroll, Alan for healthcare, Conto for banking. And so we were looking kind of our sweet spot this way. And accounting was the most obvious one where every company needs to do accounting. You have legacy software. It's a big market. And so, it's kind of broken.
Yeah.
And so we said, okay, this is what we need to fix.
Yeah. And I think like, to be honest, you did it like brilliantly, obviously. Otherwise we wouldn't be like talking today. Like we are actually like super happy with Pennylane. We've been a customer for quite some time, and I'll mention it a little bit later because I'm curious about where you're heading. But because we started talking about like the inception of the project, I'm quite curious because like there are this kind of like dogma whenever you start a company, and one of them is you shouldn't have like too many co-founders. Being a solo founder is something that's a red flag for most VCs. But if there are like more than, let's say, like 3 or 4 people, it's usually like many, many red flags. Right now, your company is worth many billions, and you are still like, I think 6 co-founders.
Seven
Seven co-founders. How exactly did you decide to split the equity? And was it like a starting point where, like people were kind of feeling that they should own a little bit more of the company or not?
So in the first company, everyone had exactly the same
Yeah.
amount of equity, each, the 6 of us. It's not the case in the second company. The main rationale we had when we started the second company, we felt, to what the point you just brought before, we raised money from day one. So maybe I didn't answer that question. The main reason why we raised money from day one is we felt, anyway, we want to build a large company. And so it doesn't matter if we give up in terms of equity. It doesn't matter to us if we give up a bit equity. What we want to maximize is that we are aiming for a huge cake, and we don't mind having a smaller share. Anyway, we are 7 co-founders, so already every co-founder has way less of the cake than if you are a solo founder. And so having a bit less of a small pie doesn't really matter. And so we wanted to be as aggressive as possible in terms of being able to go fast, hire good people from the start, stuff like this. And like to do this, you need to raise a lot of capital, and to raise capital day one with good conditions, you need to basically people invest on your track record. And so we felt like we needed to value a bit more the fact, a couple of us, because not all the 7 were in price match.
Yeah.
So we felt we needed to value the fact some of us, we had done the price match exit. We also invested a bit of our own money on top of what the VCs invested. Yeah. And then, a couple of out of the 7, we were probably 4 of us at the ideation phase, and the 3 others, they came in a few months later. And so now at Pennylane, not everyone has the same. So basically the price match founders that are at Pennylane, we have the biggest amount of equity, and then the others, they have a bit less.
Okay, yeah, that makes sense. And has it ever created some frustration along the way? Because often what you can see when a company is growing super fast, and now we're talking about billions in valuation, the small percentage, even small, is actually worth quite a lot. And have you ever found that between co-founders sometimes the equity story was a problem for certain people?
I would say the toughest moment is the beginning.
Okay.
Because at the beginning, right, it's pretty intangible, right? And so at the beginning, having to tell someone you are worth X times less, or you have less than, and you can always find arguments, but it's tough to explain why it's that kind of a gap or stuff like this. So those were not easy discussions. But I think since everyone was comfortable with them, since then we haven't had any problems.
Super interesting. And I'm also really curious because when you are 6 co-founders, 7 co-founders, sorry, you all have initially more or less the same voting rights. So whenever you go to board meetings now, because you've raised let's say the most famous funds in the world now, how does the board work, and how does the voting right works? Do you still own a vote each, or
no?
Okay.
No, so from the beginning, because we've raised on day one,
yeah.
From the beginning, I think it was only Felix and I on the board.
Okay.
So only 2 of the 7 representing the co-founders on the board. And so nowadays, as co-founders, we have absolute majority.
Okay.
So we can decide anything because we always had good conditions to raise money. But that being said, we actually invite all the others.
Yeah.
I would say, the tech guys, they don't come up. They are rather
they're invited, but often no shows.
But Tancred, our CPO, Alex, who's a CPA, they come to the board meet even if they don't have a seat or something like this. And same for investors, by the way. So not all our investors have a seat at the board, but we actually invite almost everyone. And then so far it worked well for us.
Okay. And when you negotiate around, what's the most important for you? I'm curious to understand how you see, dilution and also terms. How do you balance both? Because it's always kind of a trade-off,
So I think we've been always careful about dilution, especially because, to your point, we're already many of us, and we sometimes felt like we didn't need. So the first couple of steps of the company, we really thought in terms of steps. So it was like, okay, I want to validate that there's a real need in the market. This was like what brought us from the pre-seed, if you want, to the Series A. Then, okay, we actually demonstrated that there's some good traction with accountants. Then actually we are able to start migrating accountants, which accelerates the growth. Then we actually launched a second product. It's, like SMEs also start paying. You start using our bank account product. Now it's going to be about, are we able to demonstrate our ability to go to Germany? So there are really like steps like this. And every time we said, okay, I don't need more than this amount of money. And so I'd rather optimize for dilution than amount I want to raise. And so obviously I would say the valuation kind of comes from that thing. So for example, for our seed round, pre-seed round, if you want, I would say probably the average would be at pre-seed, the company would give up like 20-25% of their capital.
Yeah.
And we gave up 10.
Wow. Okay.
So we were able to raise money, but not diluting ourselves too much.
Okay.
Basically.
And so do you try to always keep that kind of like 10 number in terms of dilution at every round, or 10 to 15?
So this is for the first rounds.
Yeah.
When you reach like later rounds, like we are now.
Yeah.
Now I would say it's capped at 5. Like we never give up more than 5% at every round. Yeah.
Nice. Really, really awesome. And when it comes to terms, do you spend a lot of time like negotiating with funds the terms? Because obviously, like what I've seen, and we don't often talk about it, and I'm curious, like your thoughts on it. It's like you have so many different things that as a founder are not like super easy to understand, like preferred shared, waterfall, like all these kind of things. And in your case, where you've been having like different funds entering at different stages, do you see that the negotiation are quite hard sometimes also between funds who are going to have like a different class of shares? Like, yeah, I'm just curious, like how you structured everything.
So I think first of all, like we've been lucky enough that almost every round, there was lots of over subscription in a sense.
Nice.
And so we really had the negotiation power. And so I think the most amount of negotiation has been done at the beginning. And since then, in our case, every time we raise money, basically what we do is we send our terms from last round, and people understand if they don't agree to those terms that we already have last round, they won't be in.
Okay, nice.
So we've been able to keep the same terms over time, and there are definitely people should negotiate. So we have like liquid pref, we have like one-time non-participating stuff like this. And there I have to confess, so I'm not an expert at all those topics. And I am very happy that I have my co-founder, Felix, who is the guy who is basically leading those discussions together with our head of legal. We obviously have our lawyer who's helping us. It's the same lawyer we've had since Price Match for the acquisition, also for Pennylane. He's called Charles-Philippe Letellier.
Nice.
I would say we've so far so good.
Yeah.
But I obviously understand it's not everyone has this luxury. I've also been trying to understand, talking to other founders, what were the pitfalls you should like try to avoid. Also making sure. So one thing we've been optimizing for definitely is the quality of the investor.
Yeah.
So it happened to us several times that we chose one investor over another, even if the second one was offering a higher valuation, definitely, because we preferred like the quality. So I'm not a VC myself. My impression is that VCs is a small word, and like especially top tier VCs is probably even more of a small word, and their reputation is probably what is the most valuable thing for them.
Yeah.
And so if you have a number of those top tier VCs in your cap table, and you bring in a new one, I'm convinced, maybe I'm wrong, but I'm convinced the new one they cannot fuck up, right?
Yeah.
Because there will be all those other guys that will ruin their reputation if they do something bad. And so it ends up with a really small word in French, we say consanguin, right?
Yeah.
Which is a bit strange. But I think it kind of protects you as a founder as well.
Yeah.
Somehow.
Mm-hmm.
That they all know each other and that, they cannot screw up too much.
Okay. Yeah, that's great. And when you say like you were focused, on the quality of the investor, when you mentioned the quality of the investor, do you mention the quality of the partner you had a chat with, or was it really more the fund's reputation?
I would say both.
Okay.
I would say both. One thing I haven't mentioned, and in our case, I would say it's probably a bit special. So we feel, and maybe you are wrong, and maybe every founder feels this way, but we feel we are not a a super typical business in the sense like we are not just a SaaS business that acquires, direct acquisition and a bit of indirect, etc. We have this very special motion with accountants, right? Where you need to build a super complex product. You need to be super patient before your product reach product market fit. And then even once you have product market fit, those accountants, they will actually not pay a huge amount of money for your product. And most of the money is like a second step effect where, if the customers of your customers start paying also for the product, then you make more money, etc. And so we were always very careful having investors that understood our business. Because I think the worst thing you can have is people that come in and do not understand your business. And then they will have expectations that, will not be met. And then they might, in our case, they might, panic, right? Because we had to be very patient before seeing the return on our investment. If our investors did not understand and did not believe in the flywheel we were talking about, very quickly they could have said, okay, like please stop burning as much money on R&D. Like, are you crazy? And so we were very lucky so far with people, understanding. And this, you can feel it when, you do like investor talks or even due diligence. There was one round where we had, there are maybe like 2 rounds where we struggled a bit more than the other rounds. So one was the second round, because basically we had demonstrated there was demand, but we were still operating as a tech-enabled accounting firm for the very first few months. And people had to believe us that we were going to successfully switch from tech-enabled service to pure SaaS. And so there were, some people were stressed, some investors. And the second round was, at some point, I would say 2022 probably. There was some kind of tech winter a bit. And like all the fundraisings kind of stopped. And we wanted to go to market. We didn't have to, but we wanted. And nobody knew how the market was going to react. What was sure is that we saw that all the VCs, all the analysts had a lot of time because they were not looking at a lot of deals. And so they asked us a lot of questions. And you could see a lot of them asking very irrelevant questions. Okay. Because they were applying by the book their SaaS, templates and metrics, which didn't make a lot of sense in our case. And so
what's so different between like a traditional SaaS and the way you operate, you would say?
If you look at cohorts, it's very hard to define first what a cohort is, right?
Okay.
Because accounting firm, they will usually put like 5 customers, and only then they are gonna at some point, but that could be like 2 years later, that they could actually say, okay, I'm putting all my customers, right? Okay. And so tracking that cohort is very tough. And if you look at it from a macro level, it doesn't make any sense.
So it's hard for you to know the net retention, or you can still track it?
Exactly. And net retention, like, what is it? Is it accounting firm adding more customers?
Yeah, like the
is
expansion.
Is it that actually the customers start paying us more money themselves? So it's depending on your definition, there can be many ways to look at it.
Because the accountant pays, and also like the client, the end client pays, right?
We have a model where the accountant always pays for their own tool. Their own tool includes a freemium product for the customer. Today, you have around 80% of the customers of the accountants that are on freemium.
Okay.
And 20% that also pay something.
Okay, nice. But you can always tie like a customer to an accountant, right?
Yeah. But so it's tough because, sometimes the customer comes in later. Sometimes they switch accounting firm.
Okay.
It's not easy to measure really. And then there are, like with accountants, again, it's kind of, black or white. Either they like your product and they will go all in, or they don't. You also have very strong seasonality, etc. But I would say what makes it the toughest is this. And so, like computing your acquisition cost is very tough.
Okay.
Because there are a lot of touch points.
But in the end, like your retention is actually like huge, no? Like, I mean, you must have an insane retention because, I mean, for me, typically, I think we switched like to Pennylane, and it's like obviously like game changer, like for our accountant, for our CFO, like they love pretty much everything about it. And I know we will not move from it, and it's very, very sticky. So for you, I think like in terms of valuation, it must be like the one thing that investors look at very positively, no?
Yes. So the nice things about our business, one is once you found product market fit and your product really works, your acquisition cost becomes super low. because you onboard a lot of accounting firms, and you don't need an army of salespeople to do this, right? Because it's limited how many accountants there are. And then indeed, like, your retention is super high because basically what I always say is, for a churn to happen, you need to have both the accountant and the SME to want to churn at the same time, etc. So yeah. If you look at the comparables like QuickBooks in the US or Xero in Australia and New Zealand, they usually have a churn rate below 1%.
That's huge. That's huge.
Yeah.
And what really struck me with Pennylane, it's like, I feel when I look at the overall space in fintech, is usually like these companies, they always try to replace accountants or replace like a specific department. On your end, you really made them like your allies. So what was kind of like the light bulb moment where you thought, okay, like, we need to create all this partnership. We need to make sure that accountant like really love our product, so they become the one who will be the driver of the customer acquisition.
That was really like at the initiation. So I interviewed about 100 SMEs, and they actually all told me, I love my accountant, it's my doctor.
Okay.
Please don't replace him or her. And I just want to work smarter with him or her. And I really took the time to like think about the value chain, etc., which I had not done with Price Match. And so it's really from the beginning, that we got this very strong belief, and I still believe. And by the way, I think it's our main risk and weakness, because it's a very fundamental assumption, right? If that assumption is wrong, basically Pennylane will lose, right?
Yeah.
And together with accountants, right? So our destiny is very tightly linked to the destiny of accountants, because if that assumption is wrong, then the one that will win is people like Indy that basically say, I'm going to replace the accountant. And the Nader hates that there's emptiness, right? So there's always someone who's going to come and replace that doctor. But yeah, very strong belief that people will want to keep the doctor. You could question whether with AI it's going to be, and I honestly, if you ask me the same about your personal health, I personally think people will keep consulting a doctor. They will be happy that this doctor has AI to have a smarter diagnosis and stuff like this. But I think people want to have that proximity, and your accountant is not someone you only talk about accounting about. It's someone who's gonna, they know about the fact you're getting married, you're getting divorced, you want to sell, you want to give that business to your kids. They know your city because usually they live nearby, so they know how the business in the city is doing. They might hear about opportunities. So it's not someone you want to replace, I think.
Yeah, definitely. And I think there is also like something legal, with accountant, because down the line at the end of the year, you're whenever you're doing your full accounted, you still need someone who can say, okay, like, these are the right accounting books, and you can move on and double check everything, especially for tax office, which I think is the biggest pain also for for founders. And when it comes to like your expansion plan, like you were saying like early on that you want to start targeting also like Germany and go to Germany with this new round. Like what's kind of the global strategy? Do you want to still focus mainly on Europe, or do you think you eventually can go global?
I think like in Europe, because accounting is so complex, whenever we go to a market, we bring a real differentiation, because we are able to bring together the accountant and the SME on the same platform, which the legacy players have not been doing. So my initial focus is definitely, and not even Europe, it's really continental Europe, because UK looks like much more like US and Australia. And so QuickBooks and Xero are actually pretty successful in the UK. So that's my initial focus. Now, I would always have excluded the US.
Okay.
Now, this being said, at the moment, there's a wave of US startups raising a lot of money, coming to disrupt accounting and finance and stuff like this. The thing is, in the US, so you have a player that really owns the small SME market, called QuickBooks.
Yeah.
And then on top of QuickBooks, you have NetSuite. At the moment, the companies I'm hearing about that are starting to make a noise in the US are rather going after NetSuite. So rather like about going after like the scale-ups of the world. That being said, so QuickBooks is not behaving nicely with accountants in the US because they've kind of saturated the market, 80% market share. They are not growing successfully outside of the US. And so what they've started doing is kind of offering like tech services, accounting services. So like kind of sitting in between the accountant and the customer. And so there's actually demand from accountants in the US to maybe change. And then there's a question about AI. But the brand they have is insane. So
and I think what I always find interesting, in when you have startups raising a lot of money in the US, and we've seen it a bit, with Lemlist when our biggest competitors in the US, like SalesLoft, Outreach, were raising like hundreds of millions of dollars. Like the fact that they raise so much money allows them to educate,
create the market.
And it creates a market. Like people start understanding that they can replace their tool, and now it becomes clear that there are other options. And I think when in people's mind they understand that there are other options, and you've been building like a great product from the start, people start also like considering yours, and it's much easier for you to grow. You don't have to have the same like marketing and spending power than those guys, and you can actually penetrate a huge market.
So the other thing for us is the cost of localizing the product for the US is much lower. So in Europe, if you want to enter a market, you have to do accounting and taxes.
Yeah.
In the US, it's accepted that there's an accounting software and there's a tax software. And so we would only need to localize accounting to just have a chance at entering the market.
Nice.
So I would say, Germany, I hope best case, it's going to take us like 2 years to localize. US, I think in 6 months, we can probably launch a product. But then you need to spend so much more also in sales and marketing because your product is less differentiated from competition. So.
But I think you really built like a really great product. So you're also like a bit ahead in terms of software, of like UX, etc., etc. And you mentioned, that whenever you want to fundraise, you always look at kind of like the minimum amount of money that you need to go to the next step. I'm curious, during the stage, because in total you raised in hundreds of millions. Obviously, as a founder, you took some money off the table after your first exit, but also right now, when you have a business worth several billions, do you also think of secondary transaction? And if yes, what's kind of the reasoning at every stage?
Definitely yes. Probably not for the first 2-3 rounds, but since round 4, and we've done around approximately, I would say 1 round per year. We've every round done secondary.
Nice.
One thing that matters to us is every employee has stock options.
Cool.
And the problem in France is that a lot of other companies that distributed stock options and did a lot of noise about it, then the stock options were not worth a lot of money. And so I think as a founder, your worst nightmare is you feel you're giving a lot, but then people don't really value it. And so it was very important for us to make it as tangible as possible. And so every round now, we offer our employees who've been with us for more than, I think, 2 years. So there's no obligation, right? But we've done it every time. So employees that have been with us for more than 2 years, they can basically sell up to X% of the shares they've vested.
That's awesome.
I think probably in the last 2 rounds, we probably allowed our employees to cash out around 30 million.
Wow,
so it's,
that's huge.
Significant amount of money. And, it comes with a couple of problems because you have some early employees that say, I'm going to do a 6-month trip for my honeymoon. But at least everyone else says, okay, it's not a joke. It's actual money. And the figure I can, so we use a software to track employee stock options called Carta, I think.
Okay, yeah.
And so they can actually see how much it's worth, and they know it's not wind, right? Same for the co-founders with a different rationale. I want to make sure that all my co-founders are all in, and that none of them is saying, oh, I could make so much money. If I could cash out, I could do this project or whatever. I want them to be able to do all the projects they can and not think about, I could do something else. I don't know exactly how much, but probably, the co-founders, we took, I would say something like 60 or 70 altogether. Nice. So 10 million each.
Really cool.
But making sure, I don't want people to work for money, right? I want them to be all in. And I also want people to think big, not think about, I need to secure what I have right now. I want them to really aim for the moon. So I think it's good to do this if you can. And again, like every round, we were in good condition, so we could do this without a discount. And also what we've done since the beginning is every time an employee is leaving the company, we've systematically always 100% of the times had our investors buying the shares of that employee the moment they leave at the valuation of the last round without a discount.
Okay.
I think now we recently introduced a small discount, but yeah, we want to make sure it, like, one, it creates tangible value, and two, also we make sure that the employees that are still with us, they benefit from the upside, and those that leave will not get the upside if they're not with us anymore, right? So
to be honest, like I'm really like super impressed. I'm impressed, and I'm also a little bit jealous because the reality is, like, when we launched our company, like, because we had employees a bit all over, we didn't really like think of stock options in the early days because we were bootstrapped, and I was like giving money to people through like revenue share. So, you know, at the end of the year, like the profit, we would split it and people would get maybe 20, 30K. So kind of like huge bonuses, but it's still not the same. And when we cashed out like $30 million, like I decided to start giving stock option, but still, you know, we're like not in a yearly fundraising in the way you've done it. And I think this is really like the first time I hear like a founder doing this. So it's really impressive. And I think like it's truly the best way to keep an insane culture, have your co-founder like super involved, and also have people like highly motivated in the project, and seeing the company's valuation go up is super exciting because it's tied to also like what people earn. So really like hats off to you.
and maybe also, so at the beginning we would give equity to people only when they joined.
Okay.
So depending on when you joined and like kind of the type of role you had, you would get a share of the cake. And after 4 years, I would say, we've started giving equity refreshers also every year. So every year people get their salary. If they are in a job where there's a bonus, they get a bonus. But most of the bonus you get, usually, I think maybe except for sales, would be equity, which again like vests for 4 years. So it also gives a reason for people to stay, and you want this to be significant enough. Like everything else, by the way, all this is what Booking was doing. So we just learned all this from Booking, and they had great results. So
no, that's awesome.
Just giving them the copyright.
And just the question, like in terms of structuration, do you create like a new pool of stock option at every single round, or like how does that work exactly?
I wouldn't be able to tell you if it's at every single round, but definitely like as soon as we run out, we would issue again to make sure there's enough for employees. I think at the moment it's around 10% of the company that belongs to employees.
Nice.
To give you a sense of the size.
Really cool. And another question I had is at the beginning of the podcast, you know, we were talking about your vision for Pennylane to be, you know, kind of the last company, the one you can spend like 20 years like building. So my question to you is because you've raised like that many rounds, putting yourself at $1 billion valuation, what's kind of like your view on staying private versus like doing an IPO or eventually like getting acquired? Is that something you'd consider if you receive like an offer, or like how do you think about it?
So getting acquired, like we are not interested.
Okay.
And we obviously already received some offers, but as I said, like I think you sell your company either if you are bored or if you are scared. In the case of my first company, I think we were scared because Booking, you know, told us like, you know, if you don't let me buy you, I will do
replace
the same. I think thinking after it, we should not have been as scared because it was not the core business, etc. So the thing is, in our case, maybe I'm too optimistic and too arrogant, I don't know, but I'm not too scared. So I think the legacy players we are going against, you know, it's super tough for them to change. They have a level of technical debt, and you know, they are not tech companies. Like they became M&A companies. So I think it's super hard for them to actually come back. They're actually trying. So today, as we are registering this podcast, there was a news that came out that Cegid, our main competitor in France, they acquired a company called Shine.
Okay, I didn't know that.
For over €1 billion.
Wow, insane.
So they actually, it shows that they are a bit scared, and it shows that they are going, they will try to fight back. But I think, they can basically all they can do is M&A, right?
Yeah.
And integrating more products into a company that already bought tens of products I know it's super tough. So I'm not too scared. And then exciting, I'm overexcited because I think everything is still to be built. Like, when I see the product roadmaps we have, we can keep going for, years and years and years. I also think that, with all the geopolitics in the world, Europe needs, more than ever to have a more unified market.
Yeah.
If we want to resist against US or China, we need for your French company to be able to do business as easy in Germany, in Spain, as it is for New York-based business to do business in Boston or in Texas or whatever. And I think, it's gonna be slow, but I think that's where we are heading to. You're starting to see some convergence of VAT rules in the European Union. So there's this thing coming in 2030 called VIDA, VAT in the digital age. And so I think, this will push for having a more pan-European accounting software or financial OS. So that's what we are really excited about. The other trends we are really excited about is, the fact that AI is going to augment and enable the accountant to do more. And the third one is just e-invoicing, which is really our tailwind. And so to answer your question, I'm not really thinking about, private, public, whatever. And by the way, it would be Felix thinking about it. I'm more like into just the vision and building. What I can tell you is I've been part of discussions with some, through Sequoia, we are having like founders discussions. And one of the guys coaching us is the founder of HubSpot, Brian Halligan.
Yeah.
And so we had a discussion last summer around like, should you go private, public? He was saying that, at least most of the founders in the group said that, nowadays, you can actually get most of the upside from being public, which, is liquidity.
Yeah.
Even if you remain private.
True.
The best examples are probably companies like Stripe, Revolut, that are able to do private rounds at 80 billion or stuff like this.
Without the pressure of quarterly reporting and people trying to short your stock for no reason. Yeah.
And people that maybe do not really understand your vision, your business, etc. So I think if it was up to me, I would probably try to follow that path, remaining private as long as possible. I know there are other considerations. So, for example, one of the new investor that came in, he told me like, being public brings you also some kind of rigor.
New markets
discipline. It's not really something I'm passionate about. What I really care about is building a company as big as possible, really solving problems for our users. Yeah, we'll see where it brings us.
Awesome. I know we're almost running out of time, and I would have loved to continue that conversation for hours, but I'll stop with the last question. If a young founder came to you today, what's kind of like the one advice that you would give him or her?
I think I would spend like the right amount of time on the ideation phase. I think like when you're a first-time founder, you just want to jump into the thing. And I think usually you will not spend enough time thinking about, validating that what you are solving is a real pain point. People see your solution as a valid one. People are ready to pay for it. And then just thinking about the value chain and are you at the right, And I think, there's this thing from, I think it's Andreessen Horowitz that said, market always wins against a team. So, if you have a bad team and a bad market, obviously a company fails. If you have a bad team and a good market, company will actually do well. And the other way around, if you have a bad market and a good team, actually it's likely that the business will not succeed super well. And so I think, you should not underestimate the importance of the market and really pick the right spot. Because you're going to spend a lot of time, a lot of energy. And once you've chosen, it's very hard to pivot and to go somewhere else, right? So
that's awesome. Thanks a lot for this episode. It was really, really amazing. For people, I think what's the best way to follow your updates? Like, is LinkedIn the best place to
LinkedIn.
Go? Yeah? Okay, awesome. Thanks a lot, Arthur.
Thanks, Guillaume.